Good evening. If you're watching this right now, you already know something extraordinary is happening in the silver market. Silver has just touched $85,000 per troy ounce. Let that sink in for a moment. $85,000. To put this in perspective, just a few years ago, silver was trading below $30. We're not talking about a rally. We're not talking about a bull market. We're witnessing something that happens perhaps once in a lifetime. But here's what you need to understand immediately. The price you're seeing right now, it's not the shock I'm referring to in this video's title. The real shock isn't what's already happened. It's what's coming next. And whether you profit from it or get crushed by it depends entirely on what you do in the next few weeks. I'm not here to sell you anything. I'm not here to predict exact price targets or tell you to rush into trades. I'm here as someone who has studied markets for decades, someone who has seen manias born and manias die, to give you the clearest possible picture of what's actually happening right now. Because most people watching silver hit these levels are making the same critical mistakes. They're operating on emotion, not strategy. They're confusing a spectacular move with a guaranteed outcome, and they're about to learn very expensive lessons. This video is different. We're going to walk through the situation with the calm, methodical approach that separates long-term wealth builders from those who get wiped out when markets turn. We'll examine exactly how we got here. We'll explore what this price action actually means. And most importantly, we'll discuss what you should be thinking about right now, whether you own silver or whether you're considering entering this market. Let's begin. To understand where we are, we must first understand how we arrived at this moment. Silver's journey to $85,000 didn't happen overnight. It's been building for years, driven by forces that many analysts saw coming, but few believed would converge with such intensity. The first force was industrial demand. Silver isn't just a monetary metal. It's an industrial necessity. Solar panels, electric vehicles, 5G infrastructure, medical equipment, all of these technologies require silver in quantities that were unimaginable a generation ago. As the world accelerated its transition to green energy and advanced electronics, silver consumption surged. But production didn't keep pace. New mines take years to develop. Existing mines faced declining ore grades. The supply deficit grew larger with each passing year. The second force was monetary. Central banks around the world, facing crises that seemed to multiply with each year, expanded their balance sheets to unprecedented levels. Currency debasement became policy. Inflation, once dismissed as transitory, became embedded in the global economy. Investors who remembered their history began to wake up. They remembered that throughout human civilization, silver has been money. Not because governments declared it so, but because its properties, divisibility, durability, scarcity, made it naturally suited for preserving value. The third force was perhaps the most powerful: loss of faith in the traditional financial system. As debt levels reached mathematically unsustainable levels, as banking crises erupted, as currencies wobbled, people began searching for alternatives. Gold moved first, as it always does, but silver followed with far greater velocity. Why? Because silver had been suppressed for so long, trading at ratios to gold that made no historical sense, that when the revaluation began, it moved with explosive force. The fourth force was technical. Decades of price suppression had created a market where physical silver was far scarcer than paper contracts suggested. When investors began demanding physical delivery, the gap between paper and physical became impossible to maintain. Exchanges faced delivery failures. Premiums exploded. The paper market began to crack. And when it did, the price had nowhere to go but vertical. Understanding these forces matters because it tells us something crucial. This wasn't a speculative frenzy based on nothing. The fundamentals supporting higher silver prices are real. They're structural. They're not going away tomorrow. But, and this is the critical point, fundamental support for higher prices is not the same thing as guaranteed continued upward trajectory. Markets don't move in straight lines. Human psychology ensures that every major move contains periods of violent reversal. At $85,000, silver is in uncharted territory. There are no technical charts from history to guide us. There are no precedents for price action at these levels. This creates a unique psychological environment. Some investors feel vindicated. They held through years of mockery, through price suppression, through periods when selling seemed like the rational choice. Now they're sitting on gains that have transformed their financial lives. Others feel desperate fear of missing out. They see the headlines. They see the gains their friends have made. They feel physical anxiety at the thought that the opportunity might pass them by forever. Still others feel confusion. They own silver but don't know what to do. Should they sell? Should they hold? Should they buy more? The lack of historical reference points makes every decision feel potentially catastrophic. Let me be clear about something. All of these emotions are normal. They're human. But they're also dangerous if they drive your decision making. At this price level, we need to think about several specific dynamics. First, velocity. Silver has moved so far, so fast, that it has pulled forward years of potential gains into a compressed time frame. This doesn't mean the move is over, but it does mean that the easy part, the part where everyone makes money, may be behind us. Second, positioning. At 85,000, late-stage investors have poured in. People who swore they'd never touch precious metals are now buying. Your neighbor who mocked you for buying silver at $40 is now asking how to get in. This is a flashing yellow light. Third, volatility. At these levels, daily price swings can be larger than the entire value of silver just a few years ago. A 10% correction means watching $8,500 vanish in a single day. Most investors are psychologically unprepared for this. Fourth, market structure. The higher the price goes, the more unstable the market structure becomes. Exchanges implement margin changes. Governments consider intervention. Counterparty risk increases. The plumbing of the market begins to strain. None of this means sell everything immediately, but it does mean we're in a phase where different rules apply. The strategy that worked on the way up, buy and hold with conviction, may not be the optimal strategy now. We need to think more carefully. We need to plan for multiple scenarios. We need to manage risk actively rather than passively. Now we come to the central question: what is the shock I'm referring to? What could possibly be more shocking than silver reaching $85,000? The shock isn't a higher price. It might be higher prices, but that's not the point. The shock is what happens to unprepared investors when this market experiences its first major correction. Let me paint you a picture of what this looks like. Silver is at 85,000. Sentiment is euphoric. Every financial news channel is covering it. Social media is flooded with stories of ordinary people becoming millionaires overnight. The fear of missing out is reaching a fever pitch. Then, in a single trading session, silver drops $15,000. 20% gone in hours. The headlines change from celebration to panic. Margin calls go out. Leveraged positions get liquidated. The selling feeds on itself. Within a week, silver is at 55,000. People who bought at the top have lost 35% of their investment. The same social media feeds that showed Lamborghinis now show despair. The same neighbors who asked how to buy are now asking how to sell. This is the shock, not the volatility itself. That's guaranteed in a market like this. The shock is how psychologically unprepared most investors are for this reality. Because here's what happens next in this scenario. After dropping to 55,000, silver might stabilize. It might even rally back to 70,000. But the damage is done. The investors who bought at 85 panicked, sold at 55. They locked in devastating losses on an asset that had fundamental support for much higher long-term prices. They made the classic mistake. They entered an asymmetric trade at exactly the wrong time, with exactly the wrong mindset, using exactly the wrong strategy. But there's another version of the shock. What if silver doesn't correct? What if it goes to 100,000, then 150,000, then higher? This sounds like a good problem to have, but it's not, because at those levels, you face different risks. Government intervention becomes likely. Taxation schemes get implemented. Trading restrictions appear. The ability to actually realize your gains becomes complicated. Or perhaps the shock is systemic. Silver's explosion is just a symptom of a broader financial system breakdown. In that scenario, your gains in nominal terms might be extraordinary, but the world in which you're trying to spend them has changed in ways that negate the victory. The point is this: from where we stand right now, all paths forward contain significant risks. The comfortable middle ground where everyone wins has likely already passed. Let me take you back to first principles for a moment. Every major market in history moves in cycles. Understanding where we are in the cycle is more important than knowing the current price. Cycles have 4 distinct phases: accumulation, markup, distribution, and markdown. Each phase has its own characteristics, its own psychology, its own opportunities and risks. Accumulation is the phase where smart money buys quietly. Prices are low. Sentiment is terrible. The asset is out of favor. This is when Warren Buffett buys. This is when value is created. Markup is the phase where prices rise. Early investors make money. The trend becomes clear. More investors notice. Media coverage increases. This is where wealth is built for those who bought during accumulation. Distribution is the tricky phase. Prices are still rising, often to spectacular new highs. But underneath, smart money is selling to late arrivals. The public is buying. Sentiment is euphoric. Everyone has a story about someone getting rich. This is where wealth transfers from late buyers to early buyers. Markdown is brutal. Prices fall. Leverage positions unwind. Panic sets in. The asset that everyone loved becomes untouchable. This is where wealth is destroyed for those who bought during distribution. Now, the critical question: where is silver in this cycle right now? The honest answer is we don't know with certainty. Market tops are only obvious in hindsight. But we can look at the evidence. Silver has moved from accumulation through markup. That much is clear. The question is whether we're in late markup or early distribution. Some signs suggest late markup. The fundamental case remains strong. Industrial demand continues to exceed supply. Monetary conditions still favor hard assets. The structural problems that drove silver higher haven't been solved. Other signs suggest early distribution. Sentiment is euphoric. Retail investors are piling in. Media coverage is saturated. Price action is becoming unstable. Late-stage buyers are using leverage. My assessment? We're in the dangerous transition zone between late markup and early distribution. The exact top might be behind us, ahead of us, or right now, but we're close enough that strategy must change. Let's talk about the human element, because in markets like this, psychology matters more than analysis. When silver was at $30, buying required courage. You were going against consensus. You were enduring mockery. You were fighting your own doubts. But you were also buying with a significant margin of safety. At $85,000, buying requires a completely different mindset. You're going with the crowd. You're being encouraged from all sides. Your doubt has been replaced by fear of missing out. But you're buying with minimal margin of safety. The courage required at $30 was the courage to be contrarian. The courage required at $85,000 is the courage to resist temptation. Most investors have the first type of courage, but not the second. There's a psychological trap called recency bias. Our brains assume recent trends will continue. When we've watched silver climb from 30 to 85,000, our pattern recognition systems tell us it will keep climbing. This is hardwired. It's not stupidity. It's evolutionary psychology working against us in market environments. Another trap is anchoring. If you bought silver at 50,000, you've anchored to that price. When it hits 85,000, you feel smart. You extrapolate. Surely it will hit 120,000 using the same logic. But markets don't work on linear extrapolation. Loss aversion is perhaps the most powerful force. Studies show humans feel the pain of loss roughly twice as intensely as the pleasure of equivalent gain. This means when silver drops from 85,000 to 70,000, the emotional pain is enormous, even if you bought at 30,000 and are still up massively. This loss aversion drives terrible decisions. People sell at bottoms to stop the pain. They buy at tops because the pain of missing out overwhelms their judgment. Understanding these psychological forces doesn't make you immune to them, but it does give you a chance to recognize them when they're influencing your decisions. If you currently own silver, you face a specific set of decisions. Let's think through them methodically. First, acknowledge what you've already accomplished. If you bought below 50,000, you've made extraordinary gains. You've been right about a major market call. You've demonstrated patience and conviction. This is worth recognizing. But past success doesn't guarantee future success. In fact, it can breed the overconfidence that leads to giving back gains. You need to ask yourself several questions. Why did you buy silver originally? Was it for speculation? For long-term wealth preservation? For portfolio diversification? As insurance against systemic risk? Your answer determines your next move. If you bought for speculation, you need a profit-taking plan. Markets reward discipline. Consider scaling out, selling portions at predetermined levels. This isn't predicting the top. It's managing risk and locking in gains. If you bought for long-term wealth preservation, the calculation is different. Perhaps your thesis hasn't changed. Perhaps you believe the monetary system's problems are getting worse, not better. In that case, a holding makes sense, but you should still consider rebalancing if silver has become too large a portion of your net worth. If you bought for insurance, recognize that the insurance has paid out spectacularly. At some point, you need to convert some of that payout into other forms of security. Diversification isn't betraying your thesis. It's prudent risk management. Here's a framework to consider. Divide your holdings mentally into 3 buckets. Bucket 1, core holding. This is the portion you plan to hold regardless of price action. It's your long-term bet on silver as money, as insurance, as wealth preservation. Maybe this is 25 to 50% of your current position. Bucket 2, trading position. This is the portion you're willing to sell strategically. When markets get frothy, you trim this. When markets panic, you might add back. This gives you flexibility without abandoning your core thesis. Bucket 3, gratitude position. This is the portion you sell now, taking profits and redeploying into other assets or simply into your life. You buy the thing you've been wanting. You reduce debt. You create a safety fund. This converts paper gains into real-world improvement. The exact percentages don't matter. What matters is having a framework that allows you to act rationally instead of emotionally. Another consideration. Storage and security. At $85,000 per ounce, the physical security requirements have changed dramatically. What was a modest investment is now potentially life-changing wealth. Are your storage arrangements appropriate? Have you considered insurance? Have you thought about estate planning? These aren't glamorous questions, but they're the questions that separate serious investors from those who get lucky temporarily. Finally, consider tax implications. Depending on your jurisdiction, precious metals may face different tax treatment than other assets. Large sales might trigger obligations you haven't planned for. Consult with qualified professionals. Paying for good advice is cheaper than making expensive mistakes. If you don't currently own silver but are considering buying, you face an entirely different situation. Let me be direct. Buying silver at $85,000 carries enormous risk. That doesn't make it wrong, but you need to understand what you're doing with absolute clarity. First, ask yourself why you want to buy now. Be ruthlessly honest. Is it because you've studied the fundamentals and believe they support higher prices? Or is it because you've watched prices rise and fear being left out? If it's the latter, stop. Recognize that feeling for what it is, emotion, not strategy. The most expensive financial lessons come from acting on fear of missing out. If it's the former, you still need to proceed with extreme caution. Here's why. At $85,000, you're buying after an extraordinary move. Your margin of safety is minimal. If silver corrects even 20%, you're down $17,000 per ounce. Can you psychologically and financially handle that? Most investors answer yes in theory, but discover the reality is different. It's one thing to imagine handling a 20% loss. It's another to watch it happen in real time, to feel the sick anxiety, to face the judgment of people who told you not to buy. If you're going to buy at these levels, certain rules are non-negotiable. Rule 1. Only invest money you can afford to lose completely. Not money you can afford to see go down temporarily. Money you can afford to see go to zero and still sleep at night. Rule 2. Use no leverage. None. The temptation to use margin or borrowed money is overwhelming when you see prices rising. Resist it, absolutely. Leverage turns volatility from uncomfortable to catastrophic. Rule 3. Start small. Don't try to make up for missed gains by investing everything at once. Buy a small position. See how it feels. See how you react to volatility. Prove to yourself you can handle it before scaling up. Rule 4. Have a plan before you buy. Know under what conditions you'll sell. Know how you'll react if prices drop 20, 30, or 50%. Decide now when you're rational rather than in the moment when you're emotional. Rule 5. Diversify. Silver shouldn't be your only investment, especially if you're buying at elevated levels. Spread risk across different asset classes, different geographies, different strategies. Here's an alternative approach to consider. Instead of trying to buy silver at current levels, focus on building the financial foundation that would allow you to take advantage of the next opportunity. Pay off high-interest debt. Build an emergency fund. Invest in your skills and earning power. Position yourself so that when the next asymmetric opportunity appears, and it will, you have the resources and psychological stability to act on it. This might not satisfy the urgency you're feeling right now, but it's the approach that builds lasting wealth rather than temporary excitement. If you absolutely must gain exposure, consider a scaled approach. Maybe you buy a very small position now, just enough to feel engaged but not enough to harm you if it goes to zero. Then commit to adding only if prices fall significantly. Say, if silver drops back to 60 or 50,000. This way, you're buying into weakness rather than strength. You're going against human nature, which is why it works. Let's be explicit about the behaviors that destroy wealth in markets like this. Mistake 1, confusing a bull market with personal genius. Just because you made money in a rising market doesn't mean you're a trading prodigy. Markets made you look smart. Don't let that inflate your confidence to dangerous levels. Mistake 2, using leverage. I've mentioned this already, but it bears repeating. Leverage in volatile markets is financial suicide. You might get away with it for a while. You might make spectacular gains. But eventually volatility kills leverage positions. It's not a question of if, but when. Mistake 3, failing to take any profits. There's nobility in conviction, but there's stupidity in riding a position from massive gains back to zero because you refuse to ever sell. Markets reward those who take something off the table. Mistake 4, buying with money you need. If you're investing rent money, emergency funds, or money earmarked for essential expenses, you've already made a catastrophic error. The psychological pressure of needing the money transforms rational investing into desperate gambling. Mistake 5, ignoring diversification. Putting everything into one asset, no matter how compelling the thesis, exposes you to risks you can't anticipate. The world is complex. Unexpected things happen. Diversification is your protection against being completely wrong. Mistake 6, trading on emotion. Buying when you feel euphoric, selling when you feel panic, making decisions based on how you feel rather than what makes strategic sense. This is the most common path to wealth destruction. Mistake 7, listening to echo chambers. If all your information comes from people who are bullish on silver, you're not getting information, you're getting confirmation bias. Seek out opposing views. Steelman the bear case. Make sure you understand both sides. Mistake 8, ignoring tax implications. Making trades without considering the tax consequences, selling and buying back immediately without understanding wash sale rules, triggering enormous tax bills you haven't prepared for. Tax ignorance is expensive. Mistake 9, trying to time the exact top and bottom. You will not sell at the top. You will not buy at the bottom. Trying to do so guarantees you'll make poor decisions based on greed and fear. Accept that you'll leave some money on the table. That's the cost of rational strategy. Mistake 10, failing to have an exit plan. If you don't know under what conditions you'll sell, you'll make that decision in the worst possible moment. When you're emotional, when markets are volatile, when your judgment is compromised. Mistake 11, believing it's different this time. Every bubble in history has been accompanied by arguments about why traditional metrics don't apply. Sometimes they're partially right about changed circumstances. But markets still cycle. Psychology still matters. Gravity still exists. Mistake 12, neglecting security. At current prices, if you own physical silver, you're holding significant wealth. Bragging about it on social media is dangerous. Inadequate storage is dangerous. Failing to consider insurance is dangerous. Wealth attracts unwanted attention. We cannot understand silver's move in isolation. It's happening in a specific macroeconomic environment that provides crucial context. Global debt levels are at all-time highs. Government debt, corporate debt, consumer debt, all at levels that would have seemed fantastical a generation ago. This debt must either be repaid, defaulted on, or inflated away. Those are the only options. Repayment seems unlikely given the political will required. Default would crash the system. That leaves inflation, deliberate currency debasement to reduce the real burden of debt. Silver, like gold, benefits in this environment because it can't be printed. Its supply is constrained by geology and mining economics. When currencies are being debased, hard assets with limited supply tend to revalue upward. But there are complicating factors. Technology is deflationary. Artificial intelligence, automation, and productivity gains put downward pressure on prices even as money supply expands. This creates a complex dynamic where different sectors of the economy experience simultaneous inflation and deflation. Geopolitical tension is rising. Deglobalization is accelerating. The post-World War II order is fragmenting. In this environment, nations stockpile strategic resources. Silver, with its industrial and monetary properties, qualifies as strategic. Energy transition is consuming enormous amounts of silver. Solar panels alone are using silver at rates that strain supply. Electric vehicles need silver. The green economy, whatever you think of it politically, is structurally bullish for silver demand, but there are also headwinds. High prices incentivize substitution. Engineers will work overtime to find ways to use less silver or use alternative materials. This has happened with every commodity that's gotten expensive. High prices also incentivize recycling and increased production. Mining companies are drilling aggressively. Recycling operations are expanding. Supply responds to price, though with a lag. Technological change could reduce industrial demand in ways we don't anticipate. A breakthrough in solar panel efficiency that uses less silver would be structurally bearish. The point is this: the bull case for silver has merit, but it's not inevitable. Multiple futures are possible. Your strategy needs to account for this uncertainty. At $85,000, the market structure of silver trading becomes increasingly important. Physical silver and paper silver are not the same thing. This distinction matters enormously right now. Paper silver includes futures contracts, ETFs, and various financial instruments that represent claims on silver but don't involve actual physical possession. These instruments created liquidity and enabled price discovery, but they also enabled leverage and created disconnects between paper and physical markets. At extreme prices, these disconnects widen. Physical premiums explode. Delivery failures occur. The paper market's ability to suppress or smooth price action breaks down. If you own physical silver, you have the real thing. If you own paper silver, you have a claim that depends on counterparty reliability. In calm markets, this distinction is academic. In chaotic markets, it's everything. Exchange rules can change overnight. Margin requirements can increase. Position limits can be imposed. Trading can be halted. These interventions are more likely at extreme prices because regulators fear disorder. This creates strategic implications. Physical holders have more control but less liquidity. Paper holders have liquidity but more counterparty risk. Neither is purely superior. Both have trade-offs. There's also the question of government intervention. At some price level, silver becomes politically problematic. Governments don't like assets that highlight their currency's weakness. They don't like citizens fleeing into alternatives. History provides examples. Gold confiscation in the 1930s, capital controls during financial crises, windfall profit taxes on commodity producers. These aren't conspiracy theories. They're documented historical responses to market extremes. I'm not predicting these outcomes, but prudent investors consider them possible and plan accordingly. Diversifying across jurisdictions, holding different forms of silver, maintaining liquid assets, these become more important as prices rise. Whether you own silver or are considering buying, let me prepare you for the emotional experience ahead. Markets at extreme valuations are psychologically brutal. The swings you'll experience will test your discipline, your conviction, and your emotional resilience. You'll have days where you feel like a genius. Silver will surge. Your net worth will jump. You'll feel vindicated. You'll want to tell everyone. This feeling is dangerous because it breeds overconfidence. You'll have days where you feel like a fool. Silver will crash. Your net worth will plummet. You'll question everything. You'll want to sell and stop the pain. This feeling is dangerous because it breeds capitulation. The key is recognizing that both feelings are temporary emotional states, not reliable guides to action. You'll face social pressure. Friends and family who don't understand markets will question your decisions. When silver is up, they'll ask why you didn't buy more. When silver is down, they'll tell you to sell. Most of this advice will be terrible because it's driven by hindsight bias. You'll encounter confirmation bias in yourself. You'll seek out information that supports your position and ignore information that challenges it. This is human nature. The only defense is deliberately seeking contrary views. You'll experience regret regardless of what you do. If you sell and prices rise, you'll regret selling. If you hold and prices fall, you'll regret not selling. This is unavoidable. The solution is accepting that perfect decisions are impossible and good decisions are enough. The investors who survive these markets are those who prepare emotionally before the chaos hits. They decide their strategy when calm. They write down their rules. They commit to following their plan even when emotions scream otherwise. This isn't about being emotionless. It's about recognizing emotions, acknowledging them, and then choosing rational action despite them. Let's think through several possible scenarios for how this develops. Scenario 1, blow off top followed by deep correction. Silver spikes to 100,000 or higher in a final euphoric surge. Then it crashes, falling 50 to 60% in a matter of weeks. This is the classic bubble pattern. In this scenario, timing matters enormously. Those who sell into the spike do well. Those who buy at the top or hold too long get crushed. Scenario 2, gradual decline and stabilization. Silver doesn't crash, but slowly bleeds lower as industrial users substitute alternatives. As production increases, as speculative positions unwind, prices settle into a new range around 40 to 60,000. This is painful for late buyers, but not catastrophic. Early buyers remain profitable. Scenario 3, extended consolidation at high levels. Silver trades between 70 and 100,000 for an extended period, months or even years. Volatility remains high, but there's no clear trend. This tests patience. Many investors sell out of frustration. Then the next leg begins. Scenario 4, continued parabolic rise. Silver goes to 150,000, then 200,000, then higher. This sounds great, but comes with extreme risks. At those levels, government intervention becomes likely. Trading may become difficult. Conversion to other assets becomes complicated. You're rich on paper, but practical realization is challenging. Scenario 5, systemic breakdown. Silver's rise is accompanied by broader financial system stress. Banks fail, currencies collapse. In this scenario, your silver gains might be enormous in nominal terms, but the world you're living in has changed dramatically. This is the scenario where silver worked as insurance, but it's insurance against an outcome nobody wanted. Which scenario occurs? I don't know. Nobody does. But planning for multiple scenarios means you're prepared regardless of which one unfolds. For each scenario, ask yourself, what would I do? How would I respond? What's my plan? Having answers to these questions before the scenario occurs is what separates disciplined investors from those who get swept away by market currents. Let me give you several timeless principles that apply regardless of specific price action. Principle 1, preservation of capital is the first job. Making money is secondary to not losing money. This sounds conservative, but it's actually how long-term wealth is built. Avoiding catastrophic losses matters more than capturing every gain. Principle 2, volatility is the price of admission. If you want the potential for extraordinary returns, you must accept extraordinary volatility. There's no way around this. The question is whether you're truly prepared for it. Principle 3, the market will do whatever causes the maximum pain to the maximum number of participants. If everyone is positioned for a crash, the market will probably rally. If everyone is positioned for a rally, the market will probably crash. This is because markets transfer wealth from the many to the few. Principle 4, your time horizon matters more than your entry price. If you're investing for decades, short-term volatility is irrelevant. If you need the money in 6 months, you shouldn't be in volatile assets at all. Principle 5, position sizing is risk management. The size of your investment relative to your net worth determines your emotional stability and decision quality. Too large a position creates stress that leads to poor decisions. Principle 6, diversification is how you survive being wrong. No matter how convinced you are, allocate as if you might be wrong. This way, being wrong doesn't destroy you. Principle 7, the trend is your friend until it's not. Momentum works until it doesn't. Bull markets climb a wall of worry until they fall down a cliff of hope. Recognizing transitions is hard. That's why you need rules, not feelings. Principle 8, cost basis anchoring is a mental trap. It doesn't matter what you paid for silver. That's sunk cost. What matters is whether current prices represent good value for future returns. Be willing to sell assets at a loss if they no longer make sense. Principle 9, market timing is largely luck. Asset allocation and discipline are largely skill. Focus your energy on what you can control. Principle 10, the best trades are the ones you don't make. Patience is a competitive advantage. Saying no to bad opportunities preserves capital for good ones. So where does this leave us? What should you actually do right now? The answer depends entirely on your personal situation, but here's a framework for thinking about it. If you own silver with significant gains, consider taking something off the table. Not necessarily everything, not necessarily even most of it, but enough that you've locked in profits that genuinely improve your life. Enough that you can hold the rest without psychological stress. If you own silver with modest gains or losses, reassess your thesis. Why do you own this? Is that reason still valid? If yes, hold or even add on significant weakness. If no, exit without ego. If you don't own silver, resist the urge to chase. If prices correct significantly, we're talking 30 to 50% from current levels, then consider building a position slowly, but only with money you can truly afford to lose. For everyone, regardless of position, focus on building robust financial foundations, emergency funds, debt reduction, diversified investments, skills development. These things create resilience that serves you in all market environments. And perhaps, most importantly, use this moment as a learning opportunity. Markets at extremes teach lessons available nowhere else. Lessons about psychology, about risk, about crowd behavior, about yourself. Pay attention to how you feel right now. Notice the urges you experience, the fears, the greed, the rationalization. Because these patterns will repeat throughout your investing life in different contexts. Learning to recognize and manage them is worth more than any single trade. We stand at an extraordinary moment. Silver at $85,000 is genuinely historic. It represents forces that have been building for years, converging with intensity that few predicted. But extraordinary moments require extraordinary discipline. The rules that work in ordinary markets don't apply here. The margin for error is thin. The stakes are high. I cannot tell you whether silver will be at $100,000 or $50,000 a month from now. I cannot tell you whether we're at a top or halfway through a larger move. Nobody can. What I can tell you is this. Your financial future depends not on predicting price action, but on managing yourself. Manage your emotions, manage your risk, manage your expectations. Have a plan and follow it even when it's uncomfortable. Remember that markets reward patience and discipline, not cleverness and bravado. They punish overconfidence and emotion, not intelligence or effort. Whether you profit from this moment or get hurt by it will come down to decisions you make in the next few weeks and months. Decisions about position sizing, about taking profits, about emotional control, about rational strategy versus reactive trading. Make those decisions based on principles, not feelings. Based on your personal situation, not what anonymous voices on the internet are doing. Based on long-term wealth building, not short-term excitement. The shock I mentioned at the beginning, the real shock, isn't a price target. It's the psychological reckoning that comes when this market inevitably experiences its first major correction. Many investors will be unprepared. Many will panic. Many will lock in losses on an asset that may well have fundamental support for much higher long-term prices. Don't be one of them. Be the investor who planned ahead, who sized positions appropriately, who took some profits, who can weather volatility because they've prepared for it. This is how generational wealth is built. Not by catching every move, not by being perfectly right, but by surviving long enough to benefit from being approximately right while managing risk intelligently. The opportunity before us is real. The risks are equally real. Navigate both with clear eyes and disciplined action. Thank you for watching. Whatever you decide to do, I wish you wisdom in your decisions and peace in their outcomes.